Elliot Spitzer was known as the Sheriff of Wall Street before his downfall.
But now that he's gone, will Wall Street get cocky again? Let's throw that question into our Fox panel. Peter Schiff, author of Crash Proof. John Rutledge, chairman of Rutledge Capital. Joran Brook of the Ayn Rand Institute. And Mike Norman, host of BizRadio.com. Biz Radio Network. Also, Eric Desenhall is with us as well. I wouldn't forget about you, Eric. John, though, first to you. Wall Street was kind of licking its chops for the past couple of days because of all that it was put through by Elliot Spitzer. But are they doing that too early? They still got a very hard-driving Democrat in office as governor.
Oh, no. This is not a question of which party's in office or what the laws are, David. This was a man who went around Wall Street blackmailing firms I'll investigate you and knock you over. At the same time, he was raising money to run for governor. This is a bad man, and I'm very happy to see that this is over. In fact, there's an irony. You had Betsy on the show. Betsy, my friend McCoy, should be the governor of New York. She was too principled to live with the politicians, so she left politics, and you end up with a guy like Spitzer. The contrast is extraordinary between the two. But you're only as strong as your network of friends. You have to treat people well. And for a leader, what you want in business or in politics is character, character, character. It's all that matters.
Mike Norman, there are a lot of people out there to fill Elliot Spitzer's shoes, and you're seeing the crackdown on lenders and the like. What's Wall Street's reaction?
Well, Wall Street, obviously, they hate this guy. You know, there was cheering. I heard there was cheering on the Merrill Lynch trading floor when it was announced that he was stepping down. But look, we could sit here and debate his tactics all day long. There's no question about it. But when there's a lot of money at stake, look, we went through these the crackdowns on insider trading. It seems almost every decade we get a resurfacing of that, no matter what sort of remedies or implementations are put in place to keep that from happening. There's a lot of money at stake there. I wouldn't be surprised to see Wall Street kind of, try to drift back to its old ways. It seems to always, pop up in that direction.
Joran Brook, when you invest so much power in an individual, first as Attorney General, then as Governor of the state of New York, you have the power of the state behind you. Our founding fathers they thought that power had to be regulated very carefully. Did Spitzer step over that boundary at first as Attorney General and then as Governor?
Absolutely. I mean, he's not the sheriff of Wall Street. He's the bandit of Wall Street. I mean, this guy was a thug who intimidated corporations, intimidated individuals into doing his bidding, using the Martin Act, which is, I think, an unconstitutional New York law that allows these attorney generals to blackmail businesses into changing their behavior. Yes, this is clearly an abuse of power, but to begin with, too much power. I'd love to see politicians take a step back from power, but unfortunately we're not going to see that anytime soon.
But Peter, don't we need somebody, even if you disagree with Spitzer's tactics, to really crack down on practices that take advantage of investors? Because Wall Street's hard hit now, but surely you're going to have loose and fast times once again in the future.
Well, I think the investors, though, have to do a lot of this on their own and not look to government. Most people, when they go to a, used car lot, they look at the salesman there with a lot of skepticism. They understand what's going on. You got to look at the same thing when you're dealing with Wall Street. I mean, there are a lot of conflicts of interest there. Just because somebody makes a recommendation that you do something, it doesn't necessarily mean that that's what they really think that you should do. And so people have to do their own homework.
To know that. I mean, that's exactly the point. I mean, when they found these internal emails and stuff between guys like Jack Grubman pumping WorldCom and telling clients, it's the greatest thing, and then internally he's saying this is a piece of junk and we don't want it.
Nobody was forced to invest based on Goodman's recommendations.
There has to be some sort of policing on that to say, look, I'm not against the personal responsibility aspect. You're right about that. But when these firms are out there, pitching to the public, and internally they're saying a completely different thing, you can't allow that.
Joran, go ahead.
This is exactly an issue of individual responsibility. Nobody had to listen to these guys. The mutual funds, the institutional investors who were acting on it were just not doing their own research. They weren't doing their own stuff. So, to use an attorney general to go after these things is absurd. Now, when fraud is committed, prove fraud, but Spitzer never proved fraud. Spitzer used the power he had to blackmail these companies into changing behavior.
But Eric, to bring Eric Desenhall in here, but without somebody like Spitzer, is Wall Street going to get cocky again?
Well, look, I mean, human nature will not change, but I think what you had here was the French Revolution, where everybody wanted to get rid of the king, and who did they end up with but Napoleon? I mean, so was there a problem? Of course, and will Wall Street and businesses misbehave? Absolutely. But the problem is you had this whole dynamic where you could destroy companies on the grounds that you really didn't like them. And I think that in order to correct things, you have to be able to prove there was fraud. And I think one of the other things that is not really being discussed that much is the role that the news media played, not in reporting Spitzer's activity, but they were his active shock troops in printing whatever he wanted because he owned the right narrative. And I think that created a monster.
By the way, excellent piece in the Wall Street Journal today saying just that. Kimberly Strassel outlined exactly how the media did act in some cases like a co-captain of
not every member of the media.
Not every, but quite a few. All right.
Well, I mean, I think by and large what Spitzer was doing, courting the New York press, you drop off a box at the New York Times, they run with it.
All right.
Eric, we got to go. That infamous slaughterhouse.
Now, across the board.
Absolutely.
Phil, stay with us if you can. We want to bring in some others. The Financial Times reporting many Americans already looking for ways to ease the pain at the pump. Use of public transportation is at its highest level in half a century.
And there's a shift to other types of vehicles that people are buying. Much smaller cars, really the only ones that are selling these days. Are high gas prices changing America's driving habits for the better? Our Fox Business panel is back to talk about it. Peter, to you first. It's not helping, but is it long run this for the good of the country?
Well, I'm sure it's going to change people's patterns. But first of all, really quickly, it isn't a bubble in oil. By definition, when the dollar goes down, that increases demand for oil. You can't escape that. And as long as
that's
the dollar
what Phil
is
was
weak,
saying.
Yeah, but it is supply and demand. The demand is coming from
supply and demand
dollar.
on the dollar. That's exactly what we said.
But that's where you get oil prices. But as far as Americans changing their driving habits, it's easier said than done. You got a lot of people now that own SUVs with 6-year financing. They rolled over the negative equity in their trade-in, so they can't even get rid of their SUV. And with the housing bubble, you now have a lot of people who moved an hour or two away from where they work to afford a house, and now they're driving these long distances in their SUVs, and there's nothing they can do. So it's over time it's going to happen, but it's very difficult.
So, Mike, it might be about the dollar that's driving prices right now, but the fact is it's going to change the habits of Americans, these high prices, and that will affect the supply of oil we have, which will have downward pressure on the price.
My office is right next to Goldman Sachs down there on Wall Street. The other day I walked past, and every day there's this line of Lincoln Town cars out front because that's the the car services. And guess what was out there just a couple of days ago? Toyota Priuses. Now here's Goldman Sachs, they could afford to rent stretch Hummers for every single employee. Well, maybe not now with the subprime crisis, but they could at one time. Toyota Priuses lined up in front of Goldman Sachs right out in the front. It was unbelievable. Now, if that's not a sign that things are starting to change, I don't know what is. But you're absolutely right. High prices are going to cause a change in behavior, and ultimately, and look, Phil Flynn is right. The fundamentals do not support. You got a $6 million build. I used to trade down there on NYMEX. You get a $6 million build in crude, and we're making 110, 111. It's going to collapse at some point. The fundamentals will come back.
The dollar is worth a lot more when you trade.
John,
the dollar. Would you stop with the dollar?
Gentlemen, we have a lot more people on the panel.
Going down.
John Rutledge, are people in this country changing their driving habits, and this is a long-term thing, or is it just short-lived?
Well, I'm in California, Dagan, and out here it's all Priuses all the way down. So yeah, I think so. But the biggest thing you can do is not drive your car. And so staying at home, working at home, telecommuting, and all that is starting to happen. Broadband and optical fiber to the home and office is helping people to do that. But if you want to see one implication of this, look at the Manheim Index, which is the index of used car prices, because high oil prices lower the price at which you can sell a used car when you're strapped for liquidity. That's the best liquidity measure for the consumer, I know. But there are other fundamentals besides the ones we've been talking about. As the world now will return to growth, growth means more copper, more lead, and more oil demand, and that's a long-term thing. It's not something that would be a trading story, but it's something that very long-term says that the U.S. and China and others are heading toward a long-term conflict over energy supplies. and the market's going to get tighter long term, not looser.
Urine, hold on a second. Let me just bring in Urine here. What happens, for example, if there is a lot of savings of oil, as we've been talking about, a lot of Priuses are sold, people don't drive to work anymore, they work at home, and who knows, maybe the Fed gets religion and starts to raise rates a little to lower the cost of inflation. Could we end up with another oil glut, which would drive prices way lower?
I think at some point that could happen, you know, people are changing their behavior, but it's only at the margins. I think Peter's right. This is going to take a long time, and it's part of the beauty of the market. People adjust the prices. You know what? All those Californians will sell their Priuses and go back to their SUVs when oil prices come down, you know, if they come down. I think the biggest story is inflation. You know, people are going to have to change their behavior in many ways to adjust to a world in which we might have both a recession and inflation, and that's going to cause real shudders in the U.S. economy.
Phil, do you think that this is going to be a long-lasting thing, though? People driving less. With that MasterCard survey, demand's down 7 weeks in a row, right? Is this just going to disappear even if we get a little bit lower gas prices?
Well, you know this. If you've ever studied the history of oil, it's a story of boom and bust from the beginning of time. Since we started with whale oil, since the beginning of the day. Listen, I've been around long enough to know that every bull run has its correction and has its day. And yes, this thing is going to end. You know, the question is when. Is it going to end in 6 months or 6 years?
Hey,
the commodity cycle.
Phil, excuse me for interrupting you, but I just got to ask, turn around and tell me what's happening in the pit behind you.
You got it. Right now, S&P 500s, they are down a little bit. They're actually kind of quiet. There's one guy reading the newspaper, so they're fairly sideways right now over there. Down a little bit. You should have been down here the other day, David, when we had that rally going on. Now, you would have heard this. I wouldn't be able to hear you right now.
But it's just wild that you say everything is pretty quiet when, from our perspective, it seems like people are screaming their lungs out down there.
Oh, I'll tell you, this is nothing. These guys are like opera singers. They can fill this place. If my hair starts going this way, then you know something's going on.
Phil Flynn, thanks very much. Thanks, guys. We'll see you in a minute.
People's hair is doing that because they're paying $3.50, $4 for a gallon of gas.
That's right.
Well, speaking of oil prices.
Well, in resigning, Eliot Spitzer left little doubt that while he may be down, he is not out.
As I leave public life, I will first do what I need to do to help and heal myself and my family. Then I will try once again, outside of politics, to serve.
Well, could Spitzer's next career be on Wall Street? Would they hire this guy to help keep things in line internally? Our Fox panel is back along with former New York Lieutenant Governor Betsy McCoy Ross. Betsy, you know, I'm reminded of Joe Kennedy. It was sort of the reverse of this. Joe Kennedy had kind of a checkered career on Wall Street, the father of John F. Kennedy, and then Franklin Roosevelt put him in charge of the SEC, the one who was supposed to regulate. In this case, the enemy of Wall Street, perceived as such, may in fact work in Wall Street. It could happen.
It could happen. Anything is possible in politics and in the life after politics, but I wouldn't put my money on it today.
Well, Betsy, you know, one thing he said today that I thought was so interesting, he said, you know, I may come back and maybe serve the public good. And in my mind, I thought to myself, does he think he's going to come back and either be back in public office and service somehow, or do you think it could be a business
I heard
move?
a very clear assurance that he would not enter public life again.
But serving the public good could be maybe a business statement that he's going to be.
Or founding a not-for-profit.
Yeah, but Mike, you know, I think of another example. I mentioned Joe Kennedy. Prosecutors who prosecute drug dealers, very often, I'm familiar with the Miami scene, they turn corners and become the lawyers of the drug dealers. So people do that all the time. A Wall Street firm that has Eliot Spitzer working for them might get a lot of business.
Yeah, it might get a lot of business. You're right. I mean, it's like former SEC guys going to work for, you know, they know the securities laws better than anybody. They know the regulatory environment. There's no question about it. Look, he's in a, you know, he screwed up. He messed up from, you know, he made a, everybody is flawed in one way or another. He made a tragic mistake. It destroyed his life as a public person. Nobody's going to argue that he's not a smart man. I mean, he clearly is. He's very ambitious. He's very aggressive. Look, as Betsy says, you know, stranger things have happened. Wouldn't bet on it right away because I think everyone's glad he's out. But
Peter, what do you make of all the enemies that he has on Wall Street? I mean, there was no one down on the floor anywhere in New York City that I heard that was sad to see him in the predicament that he was in.
Well, I mean, that probably means at least some of the things that he did were right. I mean, maybe his tactics weren't the greatest, but I mean, obviously, if nobody down there, everybody loved him on Wall Street, he couldn't have been doing his job. But, you know, I have no idea where he's going to end up. You know, the woman who regulated me at the NASD just took a job on Wall Street. That happens all the time. But I don't know, maybe he'll show up working in a casino in Las Vegas. That seems more appropriate.
You think they can really forgive him after all that? I mean, after the threats and the tactics that he used.
That's why I said maybe he'll end up in Las Vegas. I mean, I said that's where it looks like he'd be more appropriate. I don't know. You know, 2 or 3 years from now, it could certainly happen.
It's ironic, though, we're focusing more on what turn Elliot Spitzer's life will take than on what David Patterson is going to do next, and his actions are going to affect millions and millions of people and one of the largest economies in the world.
And we will be focused on that. But this is John Rutledge, Elliot Spitzer's day. I mean, this is the day when everybody's putting into perspective what happened to him, coming up with lessons and so forth. But to his future, could you see him ending up on some firm, whether a legal firm, a securities firm, something on Wall Street?
The best public service Elliot Spitzer can perform is to simply go away. I think the question of whether a Wall Street firm is going to hire him is a sort of intelligence test. If you're a shareholder and your CEO or your board brings Spitzer in to help them with their ethical issues, you should impeach them and hire new directors. You know, Betsy's right. The real issue here is, what does this mean for markets? This is a blackout of the capital markets. These things happen from time to time. Blackouts scare people. Scared people look for witch hunts. Spitzer rode a witch hunt into office. That's what he did on Wall Street. It's his behavior there that's the real issue. When he was back raising money to become governor, that's where our spotlight ought to be. But this capital market, blackouts end. When a blackout ends, the lights will go back on, the economy will come back up, and things will be okay again. But this man caused a lot of damage, not only on Wall Street.
All right, Yarnbrook, actually, Yarnbrook, is the Phoenix going to rise again here?
You know, I wouldn't be surprised, unfortunately. I think many in Wall Street prove their suicidal tendencies over and over again, and they could hire him to deal with regulators, you know, to protect the firm against the regulators. I don't think he'll be involved with internal ethics in the firm. But I hope the one good thing that could come out of this is hopefully to rein in some of the attorney generals across the country who learned from Elliot Spitzer, who learned from his tactics, and who are attacking business on a daily basis. Let's hope that this makes them a little bit more modest.
All right. Yes, last word. Well, go ahead, Betsy, very quickly.
New York and other states should consider a constitutional amendment that prohibits people who occupy positions of law enforcement from running for other popularly elected offices.
Boy, a lot of aspiring governors who are now attorney generals wouldn't have a career. All right, we've got to leave it at that. Adding up the cost of the Iraq War.
Well, some claim the final price tag may be, but is it accurate? That's next on Fox Business. Bond insurers and ratings firms being warned by Congressman Barney Frank, act now to quell the turmoil in the bond markets, or Congress is going to have to step in.
Is that what's needed? Government intervention? Back now with our business all-stars. John Rutledge, first to you. As a libertarian, you'd hate to see government intervention right here, wouldn't you?
I sure would. You know, Barney Frank has a long history of using hearings for marketing purposes. I've testified in dozens of them myself. There's cameras in the back of the room. These guys get free airtime. This is a great topic. But the fact is, the problem with the bond market and with the mortgage market was one of failure of the technology that the finance business uses to set prices on these derivative securities. It's a fairly complicated technology called Black-Scholes. It's what brought down long-term capital management 10 years ago, and it's what created the current crisis here. Barney Frank is not going to repeal the laws of mathematics. So I think starting another Sarbanes-Oxley right in the middle of this crisis would be really dumb.
Mike, I mean, some people have compared that to the Sarbanes-Oxley, and let's go back to Mr. Spitzer for a second, but are we in that type of situation again?
Look, it's one of the rare times I think Barney Frank is right. I hold in my hand right here, right from the Federal Reserve website, from the discount window, the collateral they accept when they extend loans. The highest rated security, of course, is a Treasury bill where they will give you 98% of the face value. Municipal bonds, they'll give you 97%. There is no reason in the world. These are as safe as you could possibly get. There's no reason in the world that these securities are being rated down. You know, the rating agencies are a joke. They're terrible. You know, I worked at S&P. I mean, I got fired for telling them some of this stuff was going to blow up in a deep recession. We're not even in a recession.
We will be.
The Fed accepts this as collateral almost to the degree that it will take a
So what should be done, Mike?
Look, you gotta change the way they rate these things. You know, they give these things a tougher, harsher treatment because they say under our ordinary criteria, they're going to be too good, so we can't go with that. We have to look at it.
Who in politics, in Congress, has the common sense and the expertise to do that sort of thing, Peter?
Well, nobody. I mean, nobody in government can do that. We don't want government to get involved in that. Remember, these problems are the result of bad monetary policy. We don't want to use bad fiscal policy now. But, you know, these
there's nothing to do with fiscal policy. What are you talking about? S&P has the ability to destroy a state's finances because a couple of analysts in a back room are saying, oh, Mike, now it deserves a double A instead of a triple A.
All right, let him make his point. You know,
his point's wrong.
Hold on. We've already got, one of the counties up in Northern California is already teetering on the edge of bankruptcy. They haven't filed already. I think you're going to see a lot of these municipalities in this recession going through potential bankruptcies because they bloated up their bureaucracies during the housing boom. The revenues aren't going to be there in the recession. They're not going to get the sales taxes. They're not going to get the property taxes. And I think people do want insurance on a lot of these bonds because they buy a whole bunch of them and they want to make sure, well, gee, you know, at least we have something beyond the government's promise to pay. Because in a recession, you don't know what's going to happen.
Yarn, I see you. You're over there shaking your head.
Well, I mean, I'm sitting here in Orange County. Have we forgotten that Orange County went bankrupt not that long ago? Of course, these municipalities and counties can go bankrupt. Some of them do need insurance. The solution is not more regulation. The regulations are what have failed us so far. The solution is less regulation. The solution is to encourage competition among these rating agencies. Get rid of the kind of the licensing requirements that the government imposes on them. Let the best the best of these companies rise to the top instead of leaving it to regulators to decide who can and who cannot rate these kind of instruments.
So
less regulation is almost always the solution.
Has ever said, let's get competition into the rating business. That's the first smart thing he ever said. I'll even agree with you on that one. You're right.
And then maybe we'll get some
downgrades. Get rid of the regulators, Mike.
I said maybe we'll get them downgrades with treasuries. I can't understand why they're still AAA.
Yarn, I have to ask you, though, look at Vallejo up in Northern California.
Risk.
There's a city, example like Orange County, it's skirting bankruptcy. They might be out of money as we speak right now.
Well, but you know, the reason is simple. The reason is that in the good times when they're collecting lots of taxes, they spent like crazy. They promised everybody these amazing pensions. Every municipal employee was getting these amazing pensions, and they're running out of money as the economy slows. They can't collect as much money from us, and they're getting into trouble, real trouble. And you're going to see this across the board. Look at the whole state of California. The whole state of California is running a $16 billion deficit. And Schwarzenegger at least has the guts to say,
yeah, but how big of a percentage of the gross state product? California is $1 trillion economy, so it has a $16 billion deficit. What's that? 1.6% of its gross state product. You got to put it in context.
And we should remind everybody that there are not bankruptcies as of right now. We haven't seen the bankruptcies. Some neighborhoods are in trouble, Jefferson County, Alabama, and others, but no bankruptcies as of yet. Well, they are religious items.
Well, moments to go to the closing bell with stocks. Now they're turning lower right now.
And this after yesterday's 400-plus point rally as the Fed made $200 billion available in loans to troubled banks. Fox is back now with Tracy Burge. Tracy is at the New York Stock Exchange. Tracy.
Hi, Cheryl and Dave. Yeah, well, we're down about 30 now, and I have to tell you, no one is really surprised. You know, when I came in here before, somebody said we'll be down 100. They basically what we said earlier, came to the realization that what the Fed did was great, not terrific. People are settling into the idea, and they're pretty much pulling back on it now. You know, they're also, not to get wonky, but there was a technical level in the S&P. It was 1315, 1313, depending on who you talk to, and we broke through that. And they said that if we broke through that, we were going to probably keep going. So here we are right now. We've broken through. We're like at 1310 on the S&P right now. and odds are good. We might see a little sell-off at the close. All in all, though, it was a good day. You know, the leaders on the S&P, GE, Citi, Caterpillar. Caterpillar, of course, had great news today. Some of the laggards were AT&T and Chevron. Oil stocks did not benefit from crude being up today, nearing its all-time high of 110. And, of course, the story of the day was the airlines. You guys have been reporting, everyone's been reporting on this whole Southwest issue that they've been flying planes that haven't passed inspection. So the Amex airline index is actually down 8%. Southwest is down a ton, and all the other airline stocks are following suit. So there's very mixed screens today, green and red all over the place. Right now we're down 38. We have about 7 minutes down here. We'll see what happens. Cheryl, David, back to you guys.
Mike, you know, Tracy was bringing up the Fed move, and David brought it up as well from yesterday. I actually have to tell you, I was surprised this morning that we had an uptick, because you would have think after yesterday's 400-plus point move that today you'd see some profit taking. Are we getting that right now then at the close?
I guess so. I wasn't surprised because the market was so oversold and there was such a panic, and we made new lows on the major averages. So, you know, it was due for a bounce, and I would have thought you could have had 2 days off of that news. What's interesting is that the Fed did nothing new, really. I mean, I gave you the sheet before, David. All the collateral that the Fed says is accepting now in this term security facility, it accepts at the discount window, but the problem is the discount rate was always what the Fed should have done, lower the discount rate to the funds rate. It's the same exact thing. They had the ability to do this, so it's really nothing new. I think, you know, it surprised the market because it seems like a new convention. It is, again, you know, the Fed posturing or saying we're going to help the credit crisis. But
Mike, hold on. They did expand the level of collateral that banks can use, though. You're saying that that's not the case.
It's all accepted. It's all regulated. It has to be accepted. Bank collateral, what banks are allowed to own, it's all on there. Even, look, you got CDOs, you got all of these instruments which the Fed accepts as collateral at its discount.
But, John, at some point, doesn't the market concern itself with what the Fed is holding in collateral and possibility that it's holding some real bummers?
I think there's no risk for the Fed's collateral here, David. I'm very happy to see the market start with the 12,000 instead of 11,000. That's the victory of the week. The Fed thing this week was really the generator that kicks in when your lights are off. You know, it's temporary. You can turn a few lights on. It's better than nothing. The reason they did it is because the federal funds market wasn't working. Banks wouldn't loan money to each other and take each other's credit risk, so they're taking back collateral. These mortgage bonds this collateral is not going on the Fed's balance sheet. This is simply collateral for a loan from the Fed. And by the way,
and it doesn't. Let me just focus on that for a second, John. John, let me just focus on that. Doesn't it in any way taint the balance sheet of the Fed, even in the short term?
No, absolutely not.
Could it not?
The Fed is an enormously profitable institution. They take in reserves. They pay no interest. They always make money. This is not a problem. But the monetary base and bank reserves have not grown and are not growing. The Fed is not being generous with reserves.
All right, John.
How can it not be a problem for the Fed to have as collateral behind our currency mortgages of questionable value? That's what's going on.
Rutledge just explained it. They're not taking it. It's collateral that banks pledge for a loan for 28 days.
Yeah, and they're going to roll it over. They're going to roll it over 28 days from now. And the Fed is holding on to this risk. But, you know, there was a big sell-off in the market today. But it wasn't in the stock market. It was in a foreign exchange market. The dollar got crushed. Record low against the euro. The dollar index was at a record low. In fact, the dollar's down so much, we've wiped out a good chunk of yesterday's nominal gains.
The dollar is down so much that McDonald's is getting rid of the dollar menu and they're going to the euro menu. That's what I hear.
Yarn, look, this idea has already been floated, but I got to ask you, I've heard folks just saying the Fed just needs to go in and actually just buy those troubled mortgages. That will fix this. What do you think of the idea?
That would be a disaster. I mean, the Fed needs to stop trying to tinker with this market. It needs to stop trying to fidget here and provide a little bit of liquidity there. It needs to back off. This market needs to clear. Home prices need to still come down. You know, foreclosures are going to happen. But the market clears in the end, and we get over these things. But we're not going to get over them if the Fed keeps tinkering and creating more distortions in the market, which it does on an almost daily basis.
Like we
Step
cleared
aside,
in
let the market
1933.
work.
We did a good clearing in 1933.
No, in 1933, the Fed sucked liquidity out of the market, Mike. Study history.
The gold standard, they had to do that.
Well, you know, we ought to put,
History,
the
Mike.
gold price of the Dow up there on the monitor, or the euro price of the Dow, so American investors can have a real sense of what's happening to their wealth.
Hold on a second. John Rutledge, what about the value of the dollar? Is the dollar going down now because of what happened to the Fed yesterday?
The dollar's been going down for a long time, and the reason it has is because U.S. policy has been hostile to the dollar. We've been trying as a policy to cheapen the dollar so that American manufacturers can sell stuff at a higher price, but we've devalued the entire stock of assets to make that happen. That's a stupid policy.
John's totally
but, you know,
right.
we worry so much about
But you know what, Mike, hold on. Here's the thing, though. Everybody's talking about this big cut we're going to get from the Fed next week. That, though, is going to weaken the dollar even more. I mean, they're really stuck at this point.
I mean,
so
look,
what?
John, wait a second. Look, John Rutledge is exactly right. We got a Treasury Secretary and we got Congress running around the world saying if you keep your currency down, you're going to be branded as a currency manipulator, so you better sell ours instead. It's the stupidest thing I ever heard in the world. It's total policy. It has nothing to do with any economic. John Rutledge is 100% right. By the way, I don't know if we're going to get that big of a cut. If you look now at what's implied in Fed funds futures, you know, maybe a 50% probability that we get a 50 basis point cut. The 75 is out. It's off the table.
Maybe the Fed yesterday was just trying to avoid that half-a-point cut that everybody's expecting.
No, I think the cut is coming. There's no question. The Fed is trying different gimmicks and different methodologies in order to try to get liquidity into the market, to try to get people to trade. It's not working, so they keep coming up with a new gimmick. Instead of, again, letting just the markets flush the problems out, let them solve it. Yes, it might involve the recession. That might happen, but all they're doing is postponing the day of reckoning.
Remember, it's not just policy. It's not just policy that's driving our currency lower. It's the way we're running our economy. It's the fact that we're not saving, that we're not producing enough. We're running these huge deficits.
$57 trillion in household net worth. That is assets. Those are that's the accounting record of our savings.
It's not guys trying to battle out who's right and who's wrong. The market is down today, and it is ending down today. About 46 points down to the downside. Of course, that could change as things settle, but it's clear that we're going to end up with a double-digit downside.